चलिए मेरा वीडियो भी ऑफ है।
डन। आप स्टार्ट कर दीजिए। डन।
Okay. So, good evening, one and all. I welcome everyone on behalf of Ashwa Legal LLP Advisors. So, we welcome you to this webinar series on this topic of GST on real estate. As you all know, we have been doing series on multiple topics. And when we mean series, it is like your web series where there are different chapters. So we did in the previous chapter the basics of real estate, which included understanding the real estate sector, then understanding the relevance of RERA, understanding the basic of GST on real estate, and understanding all these definitions and concepts from RERA, which is borrowed into the GST law, and the issues revolving around the same. One very important point I would like to put across before we proceed is that we are not discussing the constitutionality of the real estate sector, because as a firm, we have a different understanding on the constitutional validity, but that would be taken separately. Right now, what we are discussing in the scheme is basis the presumption that yes, there is a tax. Though, as I said, as a firm, we have a different understanding on this entire thing. So this particular point, I thought I'll put across. Ma'am, would you like to just give a brief introduction before I take up the slides?
Yes, Vishal.
Just to give a start.
Yes. So in our erstwhile session, we just covered the other things like type of the projects, the different type of settlements and all. And in this particular session, our focus will be on the changes which were bring into the scheme through the various notification 3 to 7 actually in 2019. And I will say there are a lot of notification, lot of provisions. The provisions are related like the tax rate, then RCM. In RCM also, it's a 9(4) RCM, the only entry in 9(4) RCM, which is also very complex. It's something very calculated. There are a lot of conditions. So I think we should go a little slow, and we will try to, just have a small discussion on each and every part and point of it. And if required, sometimes like we will also like to go and read the real entry, like how it is actually written in the notification or the law itself. Because I will say yes, it will be difficult to understand, and the other part is that at this point of time you may not even be able to understand the difficulty. Maybe you will understand it after some time, or maybe while watching the recording. So we will go very slow, and the purpose is to have that clarity on each and every aspect. So there are a lot of aspects in terms of taxability. There are a lot of aspects like input tax credit, taxability, RCM. Then there are a lot of aspects for the different parties, different type of projects. So there are different kind of parties, different kind of transactions, different kind of projects, different kind of rates. So there will be, I will say, a huge kind of permutation combination will be there. So with this, we will start with the basic taxability, which was introduced by 2019 various notifications.
Okay. So again, we are moving ahead with the presumption for the time being that GST is applicable on real estate transactions. As I said, we are yet to have one very important session in this series on the constitutionality of taxation on the real estate segment. Keeping that aside, for the time being, where you are in the mode of compliance, not in the mode of litigating it, how the new scheme or how the present taxation scheme is, let us understand. So basically, we can divide our real estate taxation into different categories or different chapters. First is pre-GST. Within pre-GST, it is pre-2010 and post-2010 up to 2017. Then comes the GST era from 2017 to 31st March 2019. And the next chapter, which is currently ongoing, 1st April 19 till whatever date it continues, because there is another scheme in development with some changes. So whenever that scheme is brought into picture, that will be again a new chapter. But for the time being, we are in the 4th chapter, which is from 1st April 19 to 31st, or not 31st, I'll say ongoing till the time the new scheme, whatever, whenever it is announced, is in place. So these are some relevant notifications. The first notification, that is 4/2018, which was brought for the old scheme under the GST law. And this notification was brought with the presumption that there is tax on the real estate transactions. There is tax on the real estate transaction, and it only dwelt on the time of supply. And then came the new scheme, which was brought in by the 33rd GST Council meeting. I have given the page references where you can read about the scheme in the council meeting minutes. And it was brought by the council after recommendation of the fitment committee. I've given you the timelines with the respective page numbers where you can find the details. So whoever wants to dwell deeper into the logic and the history of the new scheme, you'll find a lot of reference here. And then these are the notifications which were issued to bring into place the new scheme. Now, what we are going to start today is understanding the new versus the old scheme, and then going into the nuances and those issues which we all are facing today in respect of the compliance also, and later on in respect of whatever notices we are receiving. Most important, we have two FAQs issued by the CBIC explaining the whole taxability and the compliances and everything under the new scheme. Obviously, these are all challengeable because none of these have any legal precedent. But yes, for the time being, we proceed with the understanding of the scheme. So let us say there is a project and you are being consulted for understanding the tax implication and maybe in future taking ahead the compliances. Now, the first thing that you should check is when this project is commenced. Is it commenced before 1st April 19 or on or after 1st April 19? If it is commenced on or after 1st April 19, then by default it is in the new scheme. Old scheme option is not available for the projects which are commenced on or after 1st April 19. Now, in the new scheme, we all have heard that there are two types of projects. We discussed in brief in our previous chapter also on this series, that one is it is RREP or the other is it is REP. Just to revise for those who may not recall, that RREP is the project where out of the total carpet area of the project, again, everything as per RERA registration. So whatever is the total carpet area of the project, out of that, if not more than 15% is commercial, in other words, residential is 85% or more, then that project is classified as RREP. And in the project where the carpet area of the commercial portion is more than 15%, then that is classified as REP. Then there are the tax rates of 1%, 5% in RREP and 1, 5 and 12 in REP. Also to inform you, these tax rates are effective tax rates. What do I mean by effective tax rates? Actually, in the rate notification, these are not the tax rates given. For example, where you are reading 5 here, it is actually 7.5, 3.75 CGST, 3.75 SGST. Reason being that there is 1/3 land deduction. So let us say 100 crore is the value of the flat. On 100 crore, there is 1/3 land deduction. So effectively, your taxable value becomes 66,66,667. On that, when you apply 7.5%, mathematically, it is equal to 5% on the entire 100 rupees. So that is how we get this particular effective rate. So whenever we are discussing the rate over here, I would just like to make this point clear that these are the effective rates, not the actual rate. These are the rate to be applied on the whole value. And these rates in itself subsume that 1/3 land deduction. So that need not be taken separately when you are applying these rates. Now, if your project started before 1st April 19, then you have a choice either to continue under the old scheme, or if you do not exercise that option of continuing under the old scheme by filing that annexure, then by default, you are in the new scheme. This is something like your income tax also, where if you want to be in the old scheme, you have to specify that at the time of filing return. Here, it was supposed to be specified in the year 2019 itself. First timeline given was 31st May, which was later on extended. If you have filed that particular annexure within the timelines given, only then you could be under the old scheme. Otherwise, you would by default be under the new scheme. Now, in case you are in the old scheme, even today because you filed that annexure within the timelines. Then what are the tax rates? Now, under the old scheme also, we have the concept of affordable residential flats, though the definition of old scheme and new scheme is different. So if you are in the old scheme, then the tax rate, again, the effective tax rate, not the actual tax rates in the notification, the effective tax rate is 8% for affordable. But you can see a red mark over there. Why there is a red mark, that you'll get to know in the upcoming slides. So the affordable tax rate was 8%, but now it has also been changed. That is why you have that red mark, but that we'll see in the later slide. So for the time being, I'm giving you the original rate. So for affordable, the effective rate was 8, and for non-affordable residential, it was 12, and for commercial, it was 12. And let me inform you, in the old scheme, ITC was available in all these scenarios. Now, if you proceed further and your project was started before 1st April 19 and it was an ongoing project. Now, what is an ongoing project? It has been defined. Definition we had covered, but I'll just summarize it again. Ongoing project is a project which had started before 1st April 19 and which did not get the completion certificate before 1st April 19, and at least some earthwork has been done on that, then that particular project is an ongoing project. So there are certain conditions which have to be satisfied to be classified as ongoing project. Now, only when the project is an ongoing project, you had the option of continuing under the old scheme by filing the annexure, or by default, you would get converted to the new scheme. Now, again, if you are converted into the new scheme, even for the old project, which is now called as ongoing project, you have to classify the project into RREP and REP as per the concept we discussed. If it is under RREP, again 1% for affordable, and for regular, you have the rates. Interesting point. If it is old project, that is ongoing project, converted into new scheme, and the project is RREP, for affordable, the rate we all know now in the new scheme is 1%. But the most important part is that both the definitions, old scheme definition and the new scheme definition of affordable, shall apply. So for affordable, being affordable in the old scheme, there was a concept or definition which is changed in the new scheme. But if it is an ongoing project converted into new scheme, you have the option of taking either of the definition to apply the affordable rate. Then comes the regular rate for residential units as well as for commercial units. If the project is RREP, the rate is 5%. As you can see here also, if the project is RREP, there is only 5% rate even for commercial. However, where the project is REP, then for affordable housing, the rate is 1%. Again, for affordable, both definitions of old and new scheme shall apply. For other than affordable residential housing, the rate is 5%. And here, for the commercial units, the rate is 12% with ITC. So this is what is applicable for those projects which are converted from old to new. Ma'am, would you like to add something or highlight any technical issue relating to this?
So Vishal, when a project was converted from earlier scheme, so were they getting the input tax credit in earlier scheme? So there
Earlier
is
scheme was allowing input tax credit across the board. So whether it is residential, commercial, affordable, non-affordable, ITC was always allowed.
So have they given some kind of formula like there should be some reversal?
Yes, yes. Now, actually, we have a separate chapter on ITC, so we are not covering it here. But since you have raised this question, let me answer you. So basically, what they have said, if I have to explain everyone in simple mathematical format without going into the technicality. So your project commenced before 1st April 19. You want to convert it into the new scheme, under which ITC will now not be allowed for the residential units or the RREP projects, and in REP for the residential units. So what logical formula they have given, that to the extent of the proportionate work done for which the time of supply has happened before 1st April 19. In other words, out of total project's value, whatever is the proportionate work done on which the time of supply has happened in the previous scheme or up to 31st March 2019, they have equated the ITC to this particular proportion. So logic is very beautiful, the mathematical logic. So what they have done, whatever ITC you have received till 31st March, again, now that ITC is not for the entire project, it is for the project which is done up to 31st March. So they have first made it 100%. So let us say your project done up to 31st March is 40%, right? And it can be certified by your engineer. So you divide this ITC by 40%. So mathematically it becomes 100% ITC, that is ITC for the whole project. Now this whole project ITC is now equated with the supply which has already materialized in the old project. So you find out of this 100% ITC or the 100% assumed ITC, I'll use the word, how much would be the ITC attributable to that much supply which has materialized in the old period, that is 31st up to 31st March 19. To that extent, ITC is eligible because for that much of supply, you are already paying tax under the old rate. Let us say this 40% ITC, which you have already availed because 40% work is done, you converted it into 100 and that 100 was proportionated to equated with the value of supply, that comes to 30. So you have taken 40, but this proportionated ITC, which is now eligible, is only 30. So 10 is the excess ITC which you are supposed to reverse. So a very beautiful mathematical calculation is given. Yes, ma'am.
We can move ahead.
Okay, perfect. Pramodji, I'll request you to keep a track of the questions. So in case there is any particular question relating to the present topic that we are discussing, you may put it across immediately so that it can be catered to immediately.
Sure.
Yeah. Now, the effective rates up to 31st March, obviously, which is the old scheme, were as under. So now this is the definition of affordable under the old scheme. As I said, the definition under the new scheme is different from the old scheme. So this was the definition under the old scheme for treating a unit as affordable. So the effective rate, again, effective when I'm saying is after subsuming that 1/3 land deduction. So this rate you'll apply on the 100% value what you are receiving, and this is subsuming that 1/3 land deduction. So the effective rate was 8%. But as I said, this has undergone a change. So you can see a note below. The note says that from this date, 18th of July 22, this has undergone a change. So this rate is applicable only up till 17th of July 22. So for affordable, it was 8. For non-affordable residential, it was 12. And for commercial, it was 12. Now, from the amended date, that is from 18th of July 2022, even for the affordable residential units, the rate has been brought at par with the regular units. Now, please remember the date of change is 18th of July 2022, where we are already in the new scheme, but we are talking about the old rate. So this is applicable only for those projects which were ongoing and for which you exercise the option of continuing under the old scheme by filing the annexure. For those schemes, and assuming the scheme is still ongoing till this date of 18th July 22, for those schemes, for affordable, the rate has been changed to 12% effective. Now, what are the rates under the new scheme? Now, this rate will be applicable. These rates would be applicable, one, to those which are new projects started after 1st April 19, which I already said will compulsorily be under the new scheme only. And those old projects, which is called as ongoing, for which you did not exercise the option of continuing under the old scheme, for them, by default, you are in the new scheme. So the same rate applies. Now here, for residential apartments, the rate is 1%. But here, before you go to the rates, you should first check the project, whether it is RREP or REP, for which I have already given you the definition, which is based on the carpet area of commercial portion. Now, important point is, whether your project is RREP or REP, in either case, for the residential portion, be it affordable or non-affordable, the rate is same. So as you can see under the RREP, for affordable, it is 1. For other than affordable, it is 5. Same under REP, for affordable, it is 1. For non-affordable residential projects, it is 5. The basic difference between RREP and REP project is for the commercial portion. As we all know, in RREP, commercial can be up to 15%. So let us take a practical example. In my entire project, 90% of the carpet area is residential and 10%, which is, let us say, the ground floor shops, are commercial. This is how I have passed the project with RERA. Now, in this particular case, since my project is a RREP project because the commercial portion is not exceeding 15%, for the shops also, which is the commercial unit, I will still apply 5% effective rate and not the 12% rate. This I am stressing on because even today, after so many years of the new scheme, this is still a confusion across many developers. that because people believe that once it is a shop, once it is a commercial unit, it has to be under the regular rate of 12% with ITC. That is not the case. So it is 5%. And most important point, just a simple way to remember, wherever the rate is 1 and 5, there is no ITC. So whether it is residential, commercial, don't worry. If you understand and remember the rate, the ITC understanding is easy. Wherever the rate is 1 and 5, there is no ITC. So here under RREP, even for the commercial units, like in my example, the shops which are on the ground floor, which is comprising of 10% of the carpet area, firstly, the rate is 5%, the effective rate. Secondly, ITC is not applicable. Whereas if it is in the REP project, then the same shop, let us say here the ground floor comprises of 20%. So now 80% is residential, 20% which is ground floor is commercial. So my project becomes REP. In this case, the residential 80% enjoys the same rate of 1%, 5% without ITC, but the ground floor 20%, which represents the commercial portion, that is shops, will now have the 12% effective rate, and ITC proportionate to the carpet area of commercial will be available. So this is a very important point I request everyone to keep in mind, because this is where I am still finding challenge from both sides, from department side also and from the industry side also, that they are mixing up between the commercial rates. Any additions, ma'am?
Yes, so as far as input tax credit is related, it will be very important calculation when we have both kind of projects. And there is one more thing, that input tax credit related to those items like which are used in the construction is not allowed, and also you cannot pay the tax using the input tax credit ledger. So two are the different things. Like sometimes what can happen, because as we understand, we can do multiple businesses even in a single registration. So sometimes that may happen that I may be having some other business in the same registration also, and I may be having some input tax credit in my ledger because from that particular business, right? Maybe I'm having a hotel where 18% is the rate and input tax credit is available. So in that particular case, we need to understand this thing, because there are some other entries are also there in the law where the tax rate is like 5%, and IDC is still not available in those entries also. But here there is an important difference, that you cannot even pay this 5% using the ITC ledger. Means even if in your input tax credit ledger, the input tax credit of your other business, which is an eligible input tax credit, so it's not ineligible, it's actually eligible input tax credit, it is lying in your input tax credit ledger, you cannot use that ITC also for the payment of this tax. So this tax will always be through the cash ledger, first thing. So we will have to take care of both things. So incoming input tax credit is also not allowed, and the outward payment through input tax credit ledger is also not allowed. So that's the important point we should take care of.
Very, very important point. So I hope this point is clear to everyone, that even if you have ITC pertaining to some other business which is otherwise eligible and it is coming into the same GSTIN, still for the payment of this 1 and 5, you have to compulsorily use the cash ledger. Sanjay Ratiji, my earnest request is that we will unmute only towards the end, so that our session is not getting derailed. If you have any queries, you can just put it in the chat box, that will be addressed, please. Pramoji, any inputs or any pointers from your side?
No, I think we can continue.
Perfect, sir. Okay. Now, once we have understood or got insight about the basic tax structure, let us now discuss on how do we discuss or how do we apply these tax structures to the different business models in the real estate sector. So let me first give you a brief ideology of what could be the different business models. So let us say I am the landowner and Shefali ji is the developer. Now, landowner approaches the developer. First possibility, a plain vanilla case where landowner is selling the land to the developer. Now, we all know sale of land is outside GST, so there is no GST implication on this transaction. I am taking the plain vanilla case. JDA will come later. So plain vanilla case, landowner sells the land to the developer, that is the entrepreneur. In this particular case, on the first leg of transaction, there is no GST. Then comes the financer. Pramoji is the financer. So the developer takes some loans from the financer for financing this project. Again, the returns which the financer is getting in the form of interest, or maybe if he is becoming partner, so in the share of profit or dividends, again, that is outside GST. Now, for the purpose of executing this real estate project, Shefali ji, who is the developer, is hiring contractors. And these contractors are raising their invoices for varied things. So whatever is the contract, it may be the RCC contract, it may be the plumbing contract, it may be the tiling contract, whatever it is, they are raising invoice on the developer. Now here, contractor will be levying GST on the developer because there is no exemption at the contractor end. Contractor will be levying GST on the developer. Most important point is whether developer, that is Shefali ji, will be eligible for ITC. So here you have to go back to the previous slide to check the RREP, REP, which project it is, and what is the tax rate. I gave you a simple understanding that wherever your tax rate is 1 and 5, you are not eligible for ITCs. So wherever Shefali ji's tax rate on her outward supply will be 1 or 5, irrespective of whether it is residential, commercial, GST, ITC will not be available to her. Fine. Then other agencies would be Shefali ji as a developer would be requiring various types of plan passing, various types of other fees and charges. So government is also one of the, I'll use the word vendor for the developer, where the government is providing various types of permissions, etc. Now here there comes a very important point that whether on all payments to government is GST applicable. So important point is that whenever there is any payment to government for plan passing, for any type of sanction, for any type of fees or charges, we have to first check one, whether it is a supply or it is merely the sovereign function. First thing that you should always check. Second, is it covered under Article 243W or 243G? Because in that case, that is also kept outside GST. And third, whether it is falling in any of the exemption entries in notification 12/2017. So whenever there is any inward, I'll say expense by the developer from the government or government agencies, you have to check in these 3 steps, 1, 2, 3. So is it a sovereign function for which the charges are levied? 2, is it any activity covered in Article 243W or G? And 3, whether it is falling in any of the exemption entries of notification 12/2017. If not, then you are liable to pay tax under RCM in general. Now, after consuming all these inward input services, the next thing will be the outward of developer, where we all have discussed this in our first chapter. That is, wherever the bookings are done before the receipt of CC or before first occupancy, GST is applicable at the rate of 1, 5 or 12. Yes, ma'am.
Yes, Vishali. So I will say the thought process of government is that if you are charging the tax on outward, so if you are selling it before the completion certificate, you are charging the tax on outward, so they're fine with it. If you are not charging the tax on outward, then they have made it taxable through like you will have to pay on the land transfer, the right to develop the land. You will have to same amount. So the valuation of that is also similar. So whatever unsold inventory you will have to charge accordingly, like 5% or
That we are going to discuss in the JDA model.
Yes.
Yes. So that will be covered in JDA model. So here, this is a plain vanilla case where the land is outrightly sold by the landowner to the developer, and the developer is developing the project. Fine. Pramoji, any questions or any particular pointers that we need to take up?
There's one question. ITC. Can we claim ITC on the purchase of commercial property for a construction company wants to use as a office premises? I think they want to...
Actually, Pramoji, it is not part of this session, because here the session is from the perspective of the builder developer. But if I have to answer it straight, I believe it will be blocked under section 17(5). So if you are the builder developer and you are purchasing commercial property where you want to set up your own office, I believe there should be no GST because there should be, no ITC under GST as per 17(5) C&D.
Right.
विशाल जी, एक और एस्पेक्ट इसमें था
हाँ जी।
कि जैसे अपने जो RREP के लिए करते हैं, तो उसमें जो 80% और 20% की कैलकुलेशन है, तो उसमें क्या है,
आपका
अगर
आपका
मैंने
आवाज ड्रॉप हो गया, आपका आवाज ड्रॉप हो गया।
अनसिक्योर्ड लोन
80%
लिया है
20%।
किसी पर्सन से,
हाँ सर
80% 20% में, जैसे
हाँ
अगर मैं
ये
किसी से रिलेटिव
हाँ
से हम्म, जैसे किसी रिलेटिव से मैंने लोन लिया है, उसका इंटरेस्ट दे रहा हूँ, तो उसको उस कैलकुलेशन में इंक्लूड करना है कि नहीं करना,
ओके
वैसे 4-5 चीजें छोटी छोटी।
करेक्ट। एक्चुअली वी हैव अ सेपरेट चैप्टर, मींस इसके आगे वाला चैप्टर आईटीसी वाला ही है, जिसमें 80-20 रूल हम डिटेल में डिस्कस करेंगे। बट नाउ सिंस शलीन भाई हैज रेज दिस क्वेरी, सो इट बिकम्स ऑब्लिगेटरी ऑन मी टू आंसर। सो शलीन भाई, आई विल शेयर माय
नहीं
अंडरस्टैंडिंग।
नहीं, अपने आगे आप आगे आराम से चलते जाइए, जैसे फ्लो चल रहा है वैसे ही चलते जाइए। सॉरी, मैं थोड़ा ज्यादा जल्दी जंप कर गया।
नहीं नहीं, कोई बात नहीं। So that is going to come as we proceed. So okay, since Shalin bhai has raised this, let me just highlight this point. I did not want to mix it here, but fine. Wherever you are under the 1%, 5% rate, as Shalin bhai very rightly pointed out, one point we are saying ITC is not available, that is fine. So it appears very simple, but it is not that simple, because there is one draconian, I'll use the word, provision which says that one thing, you are not allowed ITC, that is fine. But at the same time, out of your total inward supplies, 80% should be from registered person compulsory. Up to 20% from unregistered person would be acceptable, but out of your total inward supplies, 80% should be from registered. And if it is falling below 80%, then you have to discharge GST on that inward supply under RCM. But this 80-20 in itself is a whole webinar. This is one of the series, because as rightly pointed out by Shalin Bhai, what will be included in that, whether on personal loans taken, whether on that interest, there will be 80% will be applicable, or it can be fitted in outside GST. So that we all will discuss. So just because Shalin Bhai raised this point, I would like to highlight this here, that when we are saying you are under the 1%, 5% on which ITC is not available, along with that, there is a very important compliance which you have to do year on year, and not only at the end of the project, year on year. That is the compliance of the 80-20 rule, which means year on year, you have to ensure that your inward supply up to 80% should be from registered suppliers only. If not, for the shortfall, you have to pay tax under RCM at the rate of 18%. But this has many carve outs. We'll discuss that in our third part of this real estate series when we discuss the ITC part. Okay. Now, coming to the next type of business model. So in this business model, the landowner is outrightly selling his land to the builder developer, and builder developer will be constructing flats. In this particular case, the first leg of transaction is sale of land, which we already discussed, is outside GST. Second leg of transaction is where this builder developer would be selling the flats outside, where we have that 1%, 5%, 12%. Second model in this is that instead of outrightly selling the property to builder, the landowner may give the property to builder under a lease, which may be of any number of years. Generally, such leases are of long-term 99 years lease. And in return, the builder may be paying in monetary terms, or at times it may also take the color of the JDA type of format, where the builder may be giving the consideration in the form of some constructed flats. Then comes a third model, which is one of the most disputed, discussed, understood, not understood, again disputed type of business model, that is the JDA. So one is the plain sale of land, second is giving land under lease, and third is giving land by way of JDA. Again, giving land under lease and giving land by way of JDA, the tax treatment under the new scheme is same. So whatever we are going to discuss, tax treatment under the JDA part, that applies even where the land is given under the lease with the element of JDA. Ma'am, would you like to give some opening remarks on JDA before I go to the scheme?
For the joint development, means the landowner, I mean, there can be different kind of considerations in these cases. So we can take one ground that because now there's not a transfer, absolute transfer of the development right, but the two people are developing something together. So there can be one thing that they are the co-owner, because they are jointly developing it. And in case of ownership, whether should separately be a GST tax on it. So whatever you are saying to the third parties, you are charging the tax. That's not the case. But what you are, developing together. So because now the transaction is not of exchange or barter, but the transaction is to jointly develop something. So even if I'm getting some part of it, so let us say, let's take an example of a partnership. So in a partnership, if you are actually doing something, you are adding your own corpuses. So someone is putting land and someone is putting the construction services, and now they have become a one complete joint project for both of them. So for the profits of them, again, not about the profit, not about the sales to the third parties, but for the consideration which I am taking from that. So from that whole thing, that is the complete joint development, the owner is taking something and the developer is taking something. So here the question is whether it should be falling under the taxability or not. Shaji.
Sorry, ma'am. I think voice dropped at mine. Can you repeat this question again?
So for the joint development, because nobody is transferring, this is not a transaction of exchange. When I am jointly developing something, let us take an example of say partnership firm. So one person is getting his corpus as say land, and other is putting the construction services. Now we are jointly developing something. So what we are selling to the third parties is a different thing. There will be tax there. There is no doubt about it. But when two people are putting something together and now we are jointly developing it, jointly selling it, so whether the transaction per se between each other, can we say these are the sale purchase transaction or it's a barter actually, or actually we are just putting something together and we are jointly because doing this is the transaction of ownership and then sharing the profits out of that ownership and not actually providing the services to each other. So that can be one, I will say, thought for this, these kind of
Okay.
agreements.
Shefali ji has put me in a very difficult condition by raising the most pointed question in JDA, that whether there is actually any transaction between the landowner and developer when they enter into JDA. Correct, ma'am? Now, for this, then let us have this broad understanding of firstly the JDA models, ma'am, before I answer your question. So for the benefit of all, there are two types of JDA models broadly. One is called as the area sharing model. Now, under area sharing, what happens? Landowner says that, okay, I am not selling the land to you. I am allowing you to come and construct on this land for which I am having the construction rights, which is called as the development rights. So I am the landowner, Shefali ji is the developer. That will remain constant in all our case studies. So I enter into a contract with Shefali ji, whereby I ask her, ki, ma'am, I have land, but I do not have the expertise or the capital to convert this into a building. You have both these things. So let us understand, let us enter into an understanding, which is a contractual understanding, that I allow you, I give you the permission to enter my premises, use my rights. I'm using the word use my rights. I'm not giving you the rights. I'm allowing you to use my rights. These rights are the development rights, that you are using my development rights, for which I give you all the permissions, all the sanctions, and using these rights, you can construct this building. Now, since you are investing something in the form of your time, your efforts, your skill, and also the money for construction, I am allowing you to keep some of these constructed units for yourself and give me some constructed units. This is the area sharing JDA model, whereby I, as the landowner, will, let us say this building is of 100 flats. So will enter into this type of understanding with you, that out of the 100 flats which will get constructed on my land, you will be keeping 65 flats and you will give me 35 flats. Now, for what for you are giving me this 35 flats? These 35 flats are given to me because I am the landowner. See, once this building is in place, we all know that a building has two types of rights. One is rights in the constructed portion, and second is the UDS, that is the undivided share in the land on which this building is erected. So whenever any person is buying a flat, let us say tomorrow you are buying a flat in this building, you basically are buying two things. One is the construction part, which includes the brick, cement, etc. And the other is the UDS, which is the undivided share in land. Now, this is interesting to note that this entire JDA model, it is so legally drafted and designed that whenever I am selling any flat, the flat is being sold by two persons. Shefali ji is selling the flat where I, the landowner, always acts as a consenting party. Why? Because I am always the owner of this land portion. Always. I use this word, I repeat this word. I am always the owner of this land portion. In no point of time throughout the construction of this project, the land owner becomes Shefali ji. I always remain the land owner. But when a person, let us say you are coming and buying a flat here, you need both things to become the owner of the flat. One, the construction part, which Shefali ji is giving you, and the UDS, which I only can assign because I remain the owner. So in this particular JDA model, since Shefali ji has constructed, she has incurred her cost, she will be retaining 65% of the constructed flats. And since it is on my land, for which I am now giving away, I till date I am having the sole ownership of the entire land rights. Now I am making the sole ownership into UDS, that is undivided share in land, where I will be allowing others also to become owner of that undivided share. So against that, I am getting 35 flats. So where in the JDA model, the landowner is given some part in the constructed building, we call it as the area sharing JDA model. So now in the eyes of law, now this is interesting. In the eyes of law, I am transferring something to the developer, which is my development rights, which they are calling, I believe wrongly, I'm using this word wrongly as TDR in the notification and all, but fine. So I am transferring development rights. This is what the law understands it. And the developer, that is Shefali ji, is giving in return to me 35 flats. So this is how the taxation is looking at this transaction, that I have transferred the development rights. Shefali ji is giving me in exchange of that 35 flats. And then there are tax implications. One is the tax implication on the development rights, which is at my end because I have given development rights. And since Shefali ji is giving me construction service on 35 flats, there is tax implication on this 35 flats. This is one model. The second model of JDA is, just go to that model. The second model is the revenue sharing model. Under the revenue sharing model, what happens? Same type of contract happens. I give the permission. I allow Shefali ji to come and construct building using my development rights. But here, I am not demanding any number of flats from her. Instead, what I am saying is, you construct these 100 flats and you sell all these 100 flats outside. That is to customers. And whatever money will be coming, we will fix up a ratio. Let us say now this ratio is 35-65. So the same percentage I'm continuing. In the area sharing, this was the number of flats 35 and 65. Now here it is the percentage of revenue. So whatever 100 flats will be constructed, they will be sold outside to outside customers, and whatever money is flowing, every rupee which is flowing inside this project, 35 will come to me, which is my share, landowner share, and 65 will be retained by Shefali ji, which is the builder or developer's share. Now, interestingly, again over here, the law is looking at this, the taxation law is looking at this transaction as, I have given development rights to Shefali ji, and in return, I am getting 35% of the sale value of all the flats. This is how the law is looking at this transaction. Now, importantly, in this, there is only one transaction which is happening. That is, I am giving development rights to Shefali ji. But the second transaction which was there in area sharing is not happening. That Shefali ji is not giving me any construction service because I am not getting any flat. So one very big difference in the eyes of taxation law vis-a-vis JDA models is, in case of area sharing JDA model, there is a barter of service whereby landowner is giving development rights, builder is giving construction service to landowner. Whereas in case of revenue sharing, there is only one service flowing, that is from landowner to the developer. Now, with this basic discussion on the models, I would like to come back and answer Shefali ji's pinpointed question that whether actually there is any supply or any transaction happening. Correct, Shefali ji? This is what is your question, right? I personally understand that there is no transfer of development rights happening from landowner to builder in the JDA model. Particularly if you see the revenue sharing, I believe in revenue sharing, it is more strongly I can contest this point that there is no transfer of development rights. But even in case of area sharing, there is no transfer of development rights for the simple reason that I never transfer any rights to the builder. I only give builder the permission to come to enter my property and use my development rights to do the construction. And the point which is leading to all this taxation is, I'll tell you why this all taxation is happening, because of the stamp duty law, because of the registration acts. Because under the registration act, all these documents are now liable to be registered to get the legal validity. Plus the stamp duty also has preponed their stamp duty liability. Instead of from at the completion of project, they are saying, boss, at the starting of the project only there has to be stamp duty. So because a stamp duty levy is created on JDA, that is where the taxation laws, both income tax and GST, are also considering it as a transfer. This is my understanding. But yes, times are there. We already have multiple writs from our firm, plus there are other writs filed in the legal domain by many other firms. So I think, Shefali ji, time will tell how these transactions unfold. But my personal understanding, as I am sharing, there is no transfer of rights by me to the builder. Yes, ma'am.
Actually, in northern part of India, it's being used by many, I will say, developers as a, I will say, tool for tax planning. So what they do, they form a proper entity. Let us say a partnership firm is there. So landowner is there, he's putting his land as a corpus, and then there is the developer, and both of them are selling the plot, the final output, that is residential units or whatever, REP or RREP, whatever it is. So both of them are selling. So it's like revenue sharing, not the area sharing basis. So there the claim from those side is that we are the co-owners of this business and we put our own like corpuses into the business and then we are sharing the profits. So to each other, see if we are the partner of same partnership firms, to each other we are not providing any services. We are jointly developing something and then we are selling it to the third party. So when we are selling it to the third parties, we are charging the tax. But what we are doing jointly per se to each other, it's not taxable because it's not a supply from one party to another party. So this is a common kind of formation they do generally to, I will say, for the planning of the taxations.
So, ma'am, do you mean to say that they are creating a third entity?
Yes.
So it means now there is a third entity in the form of, let us say, it may be an AOP, if I'm putting it rightly, right? Because I don't think they will enter a
Maybe
partnership.
joint venture.
Okay, no, because see, if there is a partnership, then there is again a concern that as a landowner, am I transferring the land to the partnership? Because the partnership becomes a third entity in the eyes of laws, even in the eyes of income tax law and even in the eyes of GST law. And partnership may or may not be registered, still it is an acceptable partnership as per the Partnership Act. Now the question is, when you are creating a partnership, is the landowner transferring the land to the partnership in the first place?
He is putting it as a capital. Like this is the capital from my side.
Exactly. So when I'm saying I'm putting it as a capital, so technically or even legally, I should assign or transfer the land in the name of the partnership
Right.
by paying the relevant stamp duty on the land. And
Right.
then the partnership will be developing this particular land into a project and selling it outside, right?
Right.
If that happens, I think there will be no challenge of JDA because then it does not remains a JDA. It becomes firstly sale of land by, let us say, Vishal Podar to the firm by way of introduction. So that becomes a transfer. So technically, I assign the land in the name
Not
of
the
the
sale,
firm.
but yes, transfer we can say.
Sorry.
Not the sale of land, but yes, transfer in form of capital, yes.
Yes, so there is a transfer, correct? Even accepted by the income tax law, we have tax implication on that under the capital
Yes.
gains head also. So there is a transfer. And in that case, I believe then it will no more remain a JDA model because then the partnership is doing the construction of the project and selling it. but where we both are only coming together without forming actually a third legal entity, and we are doing together, I keeping my land and you bringing your construction service and then jointly producing it and selling it. That is where whole JDA model will come into picture, right? So I think we have had a good start to this part, which I think we can continue in the next series of this, in the next chapter of this, whereby we will now dwell in the next part into the technicalities of each type of model, area sharing, revenue sharing, within that the residential apartment, commercial apartment, REP, RREP, mixed projects, etc. So I think today's session can become the foundation for the next webinar, where we will proceed from here going into the technicalities of it. So I think now we can take up the question. So I am muting Girish ji, he's our associate partner from Kolhapur and Pune. So Girish ji, I am unmuting you.
Thank you so much for the opportunity, first of all. And it was a very nice discussion. I really enjoyed it. We covered almost all crucial points. Only one small input was the last part of the discussion, I think, which is very, very important. As in the question which was, addressed by Shefali ji was related to the two people coming in together and, one person contributing the land, other person deciding to provide the construction services. And together they are selling it to the third parties. And I think, Vishal bhai, you covered almost all possibilities like revenue sharing, area sharing, and a hybrid of both of them. But frankly, these rights, contractual rights, are coming out as a uh, product of the agreement between these two parties. And as rightly pointed out by Shefali ji, there are certain agreements. So if we have to statistically speak, the cases that we have dealt in, only 2% of the cases are drafted and designed in such a manner wherein a person is bringing land, not transferring the development rights, but developer, provides the construction services, and the rights to sell the flats or the units is jointly reserved by both the parties. Okay, so that model, I mean, the perception that we got is that that is not very popular, because from income tax perspective, that arrangement is somewhere treated as a association of person, and the effectiveness of the taxation goes away. So that is why most of the cases there is a transfer of, or allowing by the landowner to the developer to construct the property, wherein in a commercial or a usual term we call it as a transfer of development right, and then the construction happens. But of course there are certain cases wherein which we have dealt in, these two parties have agreed upon to sell the units jointly without actually transferring. And Vishal bhai, as you raise the point whether there is a requirement of transferring of land and paying of stamp duty in those cases, so as I understand, the land cannot be transferred in such cases in the name of the partnership firm. So land remains, but still they will have to pay stamp duty in such cases. And that is the reason it is not very popular among the developers, wherein there is a joint development agreement. And but yes, of course there are certain cases. So that will that change anyhow, the parts, three parts that we discussed. One is taxation about the transfer of development rights. Second, sale of flats probably would remain the same, but provision of construction services by developer to landowner. So will that third part come or not is the crucial question in such models, which are very less in numbers, but yes, still available, because it eventually depends upon how these agreements are drafted, and there can be such agreements wherein the contractual rights are drafted, arranged in such a manner.
Correct. Now, in fact, if I have to also break up this into parts, so I will say that one is a pure revenue model, what we just are having on the screen, where I also mentioned at the start that I am very strongly contesting this or believing this, that yes, this is not liable to GST because there is no flow of service between the, I'm taking your third point, Girish bhai, that there is no flow of service between the developer to the landowner, because developer is not giving anything to the landowner, because whatever construction is done is sold outside. But when it comes to an area sharing, there is this small question. See, there are two angles. First, landowner is allowing the developer to come and construct the building in his premises, I strongly still have the opinion in case, even in case of area sharing, there is no transfer of development right. So there is no tax on in the hands of the landowner or on the side of the landowner. In whoever hands it has to be paid forward charge, reverse charge, that is a different thing, but there is no tax in the first place. But when in the same area sharing, the developer is constructing something and the landowner is getting some share in that, which is the area sharing model. Yes, this question will always be tricky or tickling, that is there anything happening by the developer for the landowner, because ultimately landowner gets something against the land. Now here the interesting part is whether there is a construction service flowing from the landowner, from the developer to the landowner. Now I have a cross question to this, even if for the time being I take it this way that yes, there is a construction service flowing, because ultimately as a landowner I am now left with 35 flats. So originally before this JDA I was having my land. After the completion of this entire thing, after 3 years the completion of the project, I am having 35 flats. So definitely something has changed at my end. I have received something. In short, the developer has done something for me. But the interesting part is, what is the consideration which I have given to the developer for this? So yes, I agree in case of area sharing that there is or there can be a tax liability from the side of the developer to the extent of whatever construction services he is giving to the landowner. But then the question will come, what is the consideration? Maybe if I have to think from the accounting perspective or from the transaction perspective, it can be the consideration that we can perceive in this particular transaction can be that I am now converting my sole right in this land to UDS, and whatever is the developer's share which he is going to sell outside, I am sharing my UDS with those outsiders. So in this example, in the 65 flats which the developer is going to retain, which he is going to sell outside, I will be converting my individual right of this land into 100 UDS. Let us just visualize like this. Out of which 65 UDS I will be giving to the developer or on his instruction to any outsider. So this is, I think, the consideration which I am indirectly giving to the land to the developer against the construction service which he has given to me. So definitely from the side of developer, at least my understanding is in area sharing, there is a construction service flowing to the landowner. But from landowner side, I believe there should be no tax, whether it is area sharing or revenue sharing. But yes, it is still at a very nascent stage. Definitely, as this will proceed, whenever we will have a discussion on the constitutional history aspect, our senior partners, Avinash Bhaiya, Ashu Bhaiya will be there. We will be looking at it from the constitutional angle also. But for the time being, at the transaction angle, this is what is my understanding on the JDA taxability part, which was Shefali ji's question. So I think, Pramodji, if there are questions in the chat box, we can take up.
We have
So
a few questions on JDA. One is from Mr. Kedarnath. In case of JDA, if landowner sells his share of flat after OC is received, is it liable for GST?
No, sir.
I don't think.
Once anything is, once landowner is selling or anybody selling anything after OC, there will be no GST applicable.
Then one more question from Ms. Meenakshi. Ms. A, owner of land through power of attorney to Ms. B to get 4 floors constructed. Ms. B is partner of LLP, which will construct those 4 floors for say 40 lakhs and gives to Ms. B. Now Ms. B will be getting 2 floors out of this and 2 floors will be of Ms. A. What will be the GST supply in case of Ms. B?
Ma'am, I'll request that you please send it personally, because answering it upfront at a very short notice will be wrong. I think we should analyze this with more details, because there are multiple legs. See, what is very interesting in such type of case studies is it is not a straightforward JD also, because there is Miss A, there is Miss B, and there is also LLP of Miss B where Miss B is a partner. So it is very interesting, but I will request to please share, if it is a real life case, the actual facts with us. Definitely, we would be happy to come back to you with our understanding. I think there is one more question of Sanjay ji.
Yeah, before that, I think on that 35 flats given to landowner, if the developer sells those 35 flats on behalf of landowner and give the realization to the landowner, would that still be the area sharing?
Great carve out, Krishna ji. See, I personally believe in reality also always the builder helps the landowner to get the flat sold because builder is in that business. So whenever any customer comes, it is always coming to the builder because builder is sitting there with its sales office, right? Builder is doing all the marketing, everything. So generally builder only helps generally practically get customers to the landowner. But I think this never changes the scenario because original contract always remains of area sharing. So even if let us say builder helps get the flat sold, it will always remain area sharing. Why? Because the flats are still sold in the name of landowner. That is, landowner is considered as the owner of those flats. So I believe the answer remains same.
That may be a separate service. If builder is helping us, like he's charging
But then
something.
there should be a
Maybe
separate
service.
consideration, some commission
Yes.
or something like this.
Otherwise, our agreement will be same.
Which happens. Builder always
Yes.
keeps
They
something.
charge
So
something.
that is a different thing. Yes, that
I
becomes
think
another service.
the question from Sanjay ji was on RREP, where he says if the commercial space is less than 15%, but the builder has taken a separate RERA registration for the commercial portion building, then what will be
Yes,
the
very good question. Sanjay ji, we had addressed this in the previous first part of the series, but I'll just reiterate to answer your question. So let us say there is a single building. I'll put it in the form of a case study. There is a single building. Let us say 40%, that is the first 4 floors are commercial, ground floor shops and then offices, and the remaining 6 floors are residential. Now this is one single building, but in RERA, the builder has registered it as 2 separate projects. The 40% builder has registered as one project, which is the entire commercial part, and the 6 floors is registered as a second project. Now, I will reiterate this point that the definition of project in RERA continued in GST is the project which is registered. So in your example, even though the building is one, there are 2 separate projects. One project which is 100% commercial. So those 4 floors, which is registered as one project, is 100% commercial. So that will be treated as REP. And the remaining 6 floors, which is the second project, is 100% residential, which will be considered as RREP. Again, we can have combination of this, but answering your question, you will have to see RERA registration project, and for that project, you will apply the 15% ratio to determine RREP or REP. Yes.
JDA was entered into during service tax regime, but construction completed in 2019. Whether the service tax or GST will be applicable.
Surajji, if I have to answer upfront without going into the more details of the facts, see, if I am not wrong, during service tax regime, we already had a circular which clarified that there is no GST in that time, the service tax applicable on the development rates. So I personally strongly believe that anyways, I'm of the opinion, personal opinion, that there is no tax on development rates. But even if I have to support this, there is a circular in the service tax regime which says so. So there will be no tax on the development rights, even though the project gets completed in 2019. Yes, Pramod ji.
That's all I think we have. Girish ji have again raised hands.
Sir, you may please.
Yeah, thank you once again. This question which was raised was very relevant as to initially area gets agreed to the landowner in terms of units, and later on the builder sells it directly to the third parties on the request of the landowner because they get good clients, or they want to just eliminate the mid leg of the transaction, that is first transfer from the builder to the landowner and then landowner to the third party. They just want to avoid the in between transaction. So will that change the taxation related to the construction services provided by the builder to the landowner? Because in the original agreement the area is fixed and the area is mentioned in terms of maybe percentage or square feet or whatever, but eventually what is happening is that the actual area being transferred to the landowner is lesser because the remaining portion is directly sold to the third parties. So will that change? In my personal opinion, that should not change. But what is your view? I just want to
Yeah.
know. Yeah.
Girish bhai, I answered this earlier also when this question was raised. So see, let us say taking the same example, 35 flats are mine and 65 flats are of Shefali ji. Shefali ji is the builder. Now, since builder, as you said, is having a great repute, his entire building gets booked even before the CC. So there are, after selling his flats, obviously, firstly, the builder will look to sell his flats only. When he's still getting inquiries, he will approach me asking, Ki, Vishal, do you want to sell your flats? I'll say, yes, I also want to sell my flats, but I don't know how to market. He says, no problem. I am having customers. I will help you market the flats. Now, in this particular case, my flats are getting sold by the builder. But I understand that the original contract remains the same because we have not changed the contract, we have not revised it. I am still having the 35 flats as my rights, which now I'm allowing you to sell because you are having the customer. And as what was pointed out by Shefali ji, maybe here you can fix up some consideration for yourself because you are helping me get the customers. You may keep some 200, 300, 500 rupees per square feet as the margin, which I also will agree. Out of whatever price we will fix, 500 you will keep per square feet because you are helping me get the flat sold. So that will become another service between you and me, which will be liable to 18% because it will be a business support service. But I don't think this will change. As you also rightly pointed out, this will change the original model because let us say had you as a developer not helped me, I would have marketed it and sold it at my end as per my understanding and resources. But if you are helping me getting it sold, I still believe the original contract of area sharing remains the same. Only between you and me, there is a new transaction coming up.
Yeah, sometimes what happens, we faced a scenario, typical scenario, in this case only, connecting question, that they do an addendum to the original joint development agreement,
Okay.
and they change the area. So now, in this case, in the addendum, they reduce the area which is allotted to the builder and they increase the monetary consideration.
Okay.
So in that case, what is your view?
So in that case, see what happens now. This becomes a scenario which, let us say, till now, since we were in the basic part of JDA, we took plain vanilla entire area, plain vanilla entire revenue. Now there is a third scenario which is a mix of revenue and area, whereby like in case of, let us say, area only, we may call it as area sharing, but there is some upfront payment done by the developer to the landowner at the start of the project. So let us say he is giving me 5 crores in money form and he is giving me 35 flats. Many times such type of contracts are also agreed into, right? So
Correct.
now this is one scenario, or the other scenario which you are saying that originally he was going to give me 40 flats, but later on we made an addendum saying that, okay, you give me 5 crores and give me only 35 flats. Correct?
Right.
Now, my understanding is that the tax treatment remains the same whether I decided at the first end that I'll get 5 crores and 35 flats, or at the first I decided 40 and later on converted it to 35 flats and 5 crores, the tax impact will remain the same.
Okay. Yes. Thank you.
So
That's
I think
all,
all
Vishal bhai, I think can conclude. Then one more. If JD area sharing commenced in pre-GST where 50% work done, in pre-GST, 50% in post-GST.
So I did not find a question in this. This is only a fact scenario given. That 50% work is done in pre-GST and 50% is in GST. Now, tax on construction service to be paid in pre-GST or in GST. See, again, to the extent, again, this is a question where we will need more facts, because if 50% of work is done in pre-GST, now the question is this pre-GST 50% of work, the flats are also booked by the builder, whereby the builder is also receiving some consideration for those flats. So definitely that much part of supply has happened before the cutoff date of 1st July. So it will be leviable to tax under the old scheme or in the pre-GST, that is a service tax method. And we already have the transitional provisions in GST. So to the extent of supply that has materialized in the pre-GST era, the tax on every part of it, like the construction service, will be as per the transitional provisions. So assuming, taking your figures on facts, that 50% is the supply which has concluded as per the transitional provisions. So to that extent, the tax would be leviable in the pre-GST, that is the service tax era. Now we have added a question to this with respect to the landowner share. Now, interestingly, with respect to the landowner share, the question is, when is the landowner getting the service? That is the most important question to be answered. That is, what is the time of supply? I believe the time of supply happens only at the time of CC, because until the CC has happened, generally landowner will never get anything in the building. He is not actually getting the construction service. So I understand it happens only at the time of CC, but this is my prima facie opinion on this. Definitely, like as we always discuss, every single point will come out with multiple carve-outs. But this is my understanding in general about the construction service given by developer to landowner, that it happens at the end.
But the joint development agreement happens pre-GST. So that also will
Agreed,
have.
sir. But if you're asking when the construction service is given, and see, this becomes relevant mainly at the time of change in the taxation, like how we change from service tax to GST. So in this particular case, the construction services, and see, if let us say I talk about another scenario, pre 2019 and post 2019. So my JDS signed pre 2019, but it is getting completed post 2019. So in this case, when is the tax liability triggering? Luckily, we have the notification 4/2018, which has postponed the tax liability to the end. So by default, that notification is also treating the time of supply to happen post the completion. That is at the time of CC.
On that, yes, Vishal bhai, on that point about the time of supply of construction services by builder to the landowner, there has been one amendment, and I don't remember the exact date, but somewhere in 2022, I think there has been an amendment. Earlier, it was at the time of completion certificate, but then the amendment says till the time of completion, anytime you can do it. So why they have done it is probably because sometimes what happens is that the landowners get the properties under construction.
Correct.
And they also want to sell the properties under construction. So they should be able to utilize the input tax credit which is charged by the builder, and that is the reason milestone wise or landmark wise they charge similar to the other parties, and the landowner avails the input tax credit on those flats while selling those flats under construction to third parties.
Correct. So basically, as you rightly pointed out, this is to allow them the ITC, and basically it is an amendment, you can say, to the provision of raising invoice. So as we all know that the provision of raising invoice is on or before. So you can always raise invoice before the actual supply, because the provision allows that. So just to give that a legal color so that people do not have a confusion, that clarification was brought in, as rightly pointed out. Right. So Pramodji, I think we had a very enriching discussion with inputs from so many learned people and also our associate Girish Bhai. So I think this is the best time for you to even close this webinar and also give the introduction of our firm, because that is always reserved as your prerogative.
I think probably introduction was supposed to be given in the beginning. So I would just say thank you everyone for joining the session, and we look forward to have more session in the coming weeks. As we have announced, we will have a regular session every Wednesday. So once again, thank you, and thank you Vishal Bhai and Chipalji for deliberating on this important topic.
Thank you everyone for joining. Thank you Shefali ji for all the enlightened comments. And thank you Girish Bhai and all the learned people present on the forum. And the next part of this will continue this particular point of case studies. But yes, I'm not committing it will be next week, because we have reserved our 2-week session for discussing on some very important judgments which are in pipeline. If those judgments are pronounced, we'll first take up those judgments. If not pronounced, we will continue with this series. So thank you very much everyone. Thank you Pramod ji.
Thanks.
Bye-bye.